The report's giving confidence for some on Wall Street that the Fed could cut sooner than later. Not everyone agrees. Joining us now is Torsten Slok, Apollo Global Management's chief economist. Torsten, happy Friday. So Renaissance Macro says unemployment rate is climbing, payroll growth slowing, labor market cooling, so cuts. I know you said no cuts this year before. What do you say now?
Well, I think if we look at the average payroll growth for the last 3 months is about 200,000, for the last 6 months is about 200,000, and for the last 12 months is also 200,000. Where is the slowdown in the labor market? We also got earlier this week the JOLTS data showing that job openings actually went up. So we're seeing some move lower in the quits rate, but jobless claims are still very low. You still have the weekly data from Redbook for retail sales, also still very strong. Car sales still very strong. So there is very little drama in the U.S. economy at this point. Things are chugging along at a fairly steady rate. So in that sense, there's just no really reason for the Fed to cut rates at the moment.
Beneath the surface, though, a lot of government jobs in that report, and jobs for people with bachelor's degrees did not look as strong. Does that matter?
Well, it's true. I mean, you can slice and dice the data in different forms, but there's certainly also elements that are suggesting that there's less of a slowdown. So if you look, for example, at permanent layoffs started going down. So also, again, combined with jobless claims, has been going up for seasonal reasons. So this broad slowdown is really not very clear in that sense that we're just not seeing the economy slowing to the degree that the market seems to have this strong view that the Fed will be cutting later this year. I mean, think about it. It's always the case that, yeah, it's not this meeting, but the next meeting, that's when we'll start cutting. So let's get the data for inflation on Thursday next week. We still have 3 more inflation prints before the September FOMC meeting, and we still worry quite a bit about inflation being sticky. It's taken quite some time to get inflation to come down, and we still think that we will get some more bumpy road ahead on the inflation front.
So to you, this looks like the healthy kind of slow?
I do think that this looks very much like a soft landing, which is opening up a lot of questions about, okay, if this is a soft landing, and if, therefore, inflation is only very slowly coming down, and if job growth is only moving sideways, what's the hurry for the Fed to cut rates? There is this very important debate among FOMC members that they have a strong view that our star, meaning where the Fed funds rate should be in the long run, is roughly 2.5% to 3%. So given we're at 5.5%, we got to cut rates soon. But looking at the data just today, 206,000 non-farm payrolls, that doesn't suggest that there's a significant amount of restriction coming from monetary policy. So yes, I do still think that things are doing quite well. There really is no sign that this economy is falling apart.
What about consumer spending and credit weakness, delinquencies there? That concern you at all?
Yeah, that's right. So there's certainly the case, not only for consumers, but also for corporates, that balance sheets that are sensitive to interest rates staying high, they are certainly seeing more and more weakness. But at the same time, the offsetting effect is the stock market going up and, of course, credit spreads tightening. So we have seen some distributional consequences inside the S&P 500 in terms of where is it that there's weakness and where is it that there's strength. But if you have rates higher for longer and at the same time the stock market continues to want to go up, partly for AI reasons, partly because of the Fed saying rate cuts are coming, and at the same time we also have credit spreads very tight, I do think that these effects of the Fed funds rate staying high are being offset in a positive way by easy financial conditions with the stock market going up and credit spreads remaining tight.
So what kind of Q4, I know I'm skipping a quarter in a way, but what kind of Q4 does this set us up for, particularly the holiday season, given that there's this very uneven environment for consumers and lower income, middle income consumers are having a very different experience than just looking at the major averages and wealthier Americans would suggest?
Yeah, that's very important, John. And as you just spoke to Bob about, this issue, of course, becomes very relevant also for the next earnings season. The way to look at it, in my view, is that, of course, if you have rates higher for longer, it is going to hit those balance sheets, in this case, consumers that have the most debt. But at the same time, you have for higher income households, stock markets are, of course, still going up, as we're seeing today. You see credit spreads are very tight. And if you own fixed income, including private credit, the cash flows that you get at the moment are basically better than they have been in decades. So in that sense, households are getting a steady stream of cash from fixed income combined with stock prices up, home prices going up. It is really the case that the wealth effect continues to be quite meaningful. So in that sense, the tailwind to from easy financial conditions to the economy, in particular to consumers at the higher end and the middle income who own assets, continue to be quite strong. So that's why, yes, ultimately the Fed will get what they want, namely inflation to come down. But what we're really debating is, exactly to your point, is this in Q4, or maybe we have to get all the way into 2025 before we begin to see that slowdown that the Fed has now tried to engineer for many, many quarters.